Ladies and gentlemen, welcome back from the summer break and welcome back to the Basel IV Channel to our latest edition. For now, almost 1.5 years, we are recording these little videos and use them as our modern version of a regulatory newsletter. And we altogether produced, I think, more than 40 episodes of the Basel IV Channel in English and in German. And as far as we can see, it's extremely successful. We have more than 40,000 clicks already on our YouTube channel, and that is making us very proud. Thank you very much. That is motivating us a lot. Thank you a lot. We will keep on and try to improve even the quality of these little videos. Until now, we were focusing mostly on the Basel IV topics. We were seeing videos about the changes in credit risk, in market risk, and in operational risk, and sometimes also we produced some special editions when there were quite important topics, like for example the relation between regulatory reporting and IFRS 9. Since it's a little bit quiet in related to Basel IV, we want to widen the scope of the Basel IV channel a little bit and also want to touch on other topics that include regulatory challenges for credit institutions in Europe and worldwide. So today, it's a kind of premiere. We will focus today on stress testing. As you maybe all know, in 2018 there will be another EBA stress test, and there will be more than 40 banks that have to participate in this EBA stress test, and even the other from the ECB supervised banks will have to participate in that stress test. We know the stress test already from the years 2016, 14 and some years before, and the experience from these stress tests is that literally these are quite stressful exercises. The draft EBA stress test methodology was published in June 2017, and on the first look it sounds pretty similar to the methodology we have seen in 2016, but of course the devil is always in the detail. There are definitely some important challenges, and we are going to speak about these challenges today. I personally think the biggest challenge for the credit institution is that the EBA stress test will be based for the first time on IFRS 9 figures. Before we start with the details, please give me the opportunity to introduce myself. My name is Martin.neisen. I'm a partner in PwC here in Frankfurt. I'm leading the regulatory management practice, and as part of that I'm also leading the global Basel IV initiative. Like always, I'm not alone here. I'm again with some experts.
Hi everyone, this is Kaan Aksel. I've been working closely with Martin and Stefan on various topics related to stress testing in the last years, and on this YouTube channel recording we would like to discuss with you especially the incorporation of IFRS 9 relevant provisioning rules in the stress testing framework that will be happening in 2018. That will be the main subject that I would like to be talking about in the next slide deck.
Hello, my name is Stefan Röth. I'm a senior manager at the Regulatory Management Division of PwC in Germany, and I have been supporting banks in the performance of the EBA stress test since 2014, and therefore I'm really looking forward to doing it all again in 2018.
Hello, Ryan.Davis, senior manager here in PwC Frankfurt. Similar to Stefan, have been involved in EBA stress tests in the past and within stress testing more broadly, both in Europe, in the UK and throughout Asia Pacific, and looking forward to spending some time today to discuss the 2018 stress test process.
Let's have a look at our agenda today. After a short introduction to the known facts about the 2018 stress test, we will start with a deep dive comparing the draft methodology to the 2016 exercise, and after that we take a short outlook on the lessons learned from 2016 and next steps that banks should be taking today.
So without further ado, we move into the introduction. So here we set out a bit of a timeline for what we expect will be, I guess, the next, 6 to 12 months with regards to the EBA 2018 stress test process. Of course, the draft methodology has already been released, and we'll talk a little bit later about what the draft methodology looks like and how it compares to the 2016 stress testing process. We also expect at some stage the ECB will confirm that in addition to the banks that have been called out by the EBA in terms of being covered by the stress testing process, all directly supervised SSM banks will be included, will be required in parallel to do some sort of stress testing process in line with the EBA methodology. Of course, that was the case back in 2016, and we would expect that will be the case for the 2018 process as well. Then, as we move along, would expect the final methodology templates and scenarios to be finalized February 2018, with the execution of the stress test being run by banks through Q1, Q2 in 2018, and those results should be submitted through that period as well, with the publication of results in Q3 2018. Moving along to the left-hand side of the page, a couple of points there around the coverage, the framework, and some of the assumptions. So if we start with the assumptions down the bottom, common simplified tax ratio of 30%, static balance sheet, that remains unchanged from previous processes. In terms of the framework, so there's a basis and adverse scenario, so a base and adverse scenario for the 3-year period 2018 to 2020. And we'll see a little bit later why that poses particular challenges, this 2018 starting point. No hurdle rates, so no set hurdle rates, but the expectation is that the result of the stress test would be an input for the SREP process. And with regards to coverage, we'll see in a moment how this is spread across different European territories, but in a nutshell, 49 European banks are covered, 35 of which fall under the jurisdiction of the SSM, covering 70% of assets in the European banking sector. One thing to note here as well, I mentioned before, of course, we do expect that the ECB will require all directly supervised SSM banks to do some sort of stress testing process in line with the EBA stress testing methodology. So we await further word on that. As I mentioned before, in terms of the spread of institutions across Europe, I mentioned there were 49 banks, 35 of which fall under jurisdiction of the SSM. Here, this just shows essentially how that spread across the various countries across Europe.
And now that we took a look at the basic outline of the stress test, let's start with some more details on scenarios and basic assumptions. Much of this has already been mentioned by Ryan. We still have a static balance sheet assumption. We still have 2 scenarios, baseline and adverse, which are covered, and they are provided as before by EBA, ECB, and the European Systemic Risk Board. However, 2 important changes as compared to 2016 stand out and need to be mentioned, and the most obvious of which and the most challenging aspect of the 2018 stress test surely is the inclusion of IFRS 9 values. As you are well aware, IFRS 9 will enter into force at the beginning of 2018, and therefore already the starting point, end of year 2017, has to be adjusted to take account of IFRS 9 values. So basically the starting point for the stress testing exercise will be the 1st of January 2018, and banks are required to produce IFRS 9 values for this starting point, which on the one hand side means that all the requirements of IFRS 9, for example, which positions are fair valued and which positions are accounted for at cost, have to be available for the 1st of January 2018. Provisions according to IFRS 9 have to be available. The allocation of loans to the 3 stages in the impairment model, all of this has to be available at the very beginning of the stress test for the 1st of January 2018. And hand in hand with that, of course, go the IFRS 9 transitional provisions. Even though these have not been formally agreed upon by the European Union and have not been published in the EU's official journal yet, everyone expects them to be published in the second half of 2017, and therefore they would have to be taken account of in the stress test, and there is already templates taking account of these transitional provisions and requiring banks not only to apply them, but also to present in very much detail what the effects of these transitional provisions are. Talking about future regulatory requirements, as before, the methodology advises banks that they shall take account of regulatory changes if these have been agreed and entered into force in 2017, even though they may actually influence banks only in 2018 or 19. And this in fact means that probably everything connected to CRR2 or Basel IV will not play any part in the EBA stress test. However, we still assume that the European Union might finalize the new securitization framework, and if this is done in the second half of 2017 and is published in the EU's official journal, this basically means that it should influence the methodology and the results of the stress test as well, and we are all waiting if there will be some kind of clarification from the supervisors of how to deal with the new securitization framework if it enters in force in 2017, because obviously it doesn't exactly fit into the templates that have been provided by the EBA in the summer. To go into even more details, and this is a slide that we basically could have shown in the previous years as well, the calculation of the stressed CET1 ratio, which is the main result of the stress test, can be done in 4 steps, with the first step being done by the regulators, by the supervisory authorities, which have to specify the macroeconomic stress scenarios, both baseline and adverse. And as before, they will also provide a set of parameters for more simplified procedures for those banks which do not use internal models. Step 2 then means the transformation of these macroeconomic parameters into the stressed parameter estimation. For example, if you look to the issue of credit risk, stressed PDs and LGDs will have to be calculated by banks in order to perform the default and impairment calculations. And this is step 3, the major building block of the stress test to be done by the banks, where they have to calculate the impact of the stressed scenarios on credit risk, market risk, interest income, non-interest income, conduct and op risk, and all of these building blocks then influence the Common Equity Tier 1 by means of a P&L impact or an OCI impact, or they will have some effect on the risk-weighted assets, and both come together in the calculation of the capital ratios, which will then be stressed, meaning less CET1 on the one hand side, more risk-weighted assets on the other hand side, and therefore in the most cases leading to a decrease of the capital ratios. However, and here we turn to step number 4, there is no hurdle rate, so there won't be a digital result of the stress test, meaning that banks have either passed it or not, but the results of the stress test will feed into the SREP process and will be considered when determining capital add-ons. That is also why the timeline for the stress test is quite tight, because the results have to be available before the SREP decisions are made. And if you look into the templates that were provided by the EBA in the summer, you can see on the capital template that there is also some lines dedicated to the SREP process and to the SREP minimum capital requirements. Now, having given you a short overview about the way the stress test works, we now turn to a more detailed look at the different types of risks which have to be covered, and I hand over to my colleague Kaan, who will start with the topic of credit risk.
Well, in the context of the stress testing framework for 2018, again, credit risk plays the most significant role among the risk categories. The scope is based on static balance sheet assumption, which is the same thing that has not changed since stress testing framework of 2016. And all positions which are not classified at fair value are within the scope. For the modeling purposes, definition of macroeconomic factors over time needs to be laid out. The relevant, according to the relevant two scenarios, which we call the baseline and the adverse scenario. Important point is as well the macro factors along the scenarios should be translated into stress factors for PD, LGD, and for the staging, which needs to be obviously estimated by the institutions. If there is no translation function available, either through the existing Pillar 2 framework or through other stress testing framework within the institution, then it could be a difficult task to solve. There is a hierarchy for the PD LGD models to take into account. If ideally we have the models that has been solemnly designed and developed for IFRS 9 purposes in the context of PD LGD models, we would need to be using them, and if not, we should be using the IRB models. And if neither the first nor the second model category are available, then we should be using the non-approved models, not approved in the sense of Pillar 1, of course, but is available at various organizations and institutes as so-called Pillar 2 models that should be used. And if none of this available for some reason, then benchmark values will be provided by the EBA, ECB guidelines and relevant material related to the stress testing. The impairment flows and the calculations should be done according to the Pillar 1 credit risk approach categories, which are as well aligned with the core app asset classes and by countries, and this would need to follow up the same structure. There are significant differences to the previous EBA stress testing framework that has been released by EBA relevant documents before 2016. The first and far more important aspect is that we have to be using the IFRS 9 impairment framework, and the impairment simulation should be based on IFRS 9 instead of on IAS 39, which is the biggest difference in my view compared between 2016 and 18 frameworks. Transition effects should be as well taken into account, and this must be reported as of 1st January 2018. The historical data, meaning in this context of IFRS 9, the default rates must be estimated or generated and reported for the years 2015, 16, and 17, and this would have been the case with 2018 as well. The IFRS 9 staging approach in stress periods would need to follow up the migration of exposures between stages. This must be reported, including the so-called migration probabilities. And the banks, if they have any internal models, they should be using their own models rather than creating new ones just for the sake of the stress testing purposes. Additional staging criteria might be given by the regulator. This should be as well taken into account. No migration from stage 3 to either stage 1 or stage 2 are allowed in this context, so it's one thing that we need to emphasize here. The risk parameters PD and LGD are required not just for 12-month horizon as well as for the lifetime horizon for all those exposures that have been actually shifted or staged into stage 2 and 3. Quantitative and qualitative questions regarding IFRS 9 methods must be as well answered along a large number of other aspects defining and determining the framework for IFRS 9. There are several staging related and estimation related issues around IFRS 9 and how they should be incorporated with the 2018 stress testing framework. About stress testing framework, some of them I would like to highlight here. For the stage transfer modeling in stress must be consistent with the accounting approach available inherently in the institution. Simplifications to T0 methodology must be evaluated and documented if this has been applied for certain asset classes and segments. Differences between on-group level application of IFRS 9 methodology and on institution level application of IFRS 9 methodology must be as well documented, and if there are significant differences, this needs to be arguably justified with relevant answers and feedback. In terms of the translation of the macroeconomic factors into PD and LGD shifts, the speed of convergence to the long-term trend definitely needs to be analytically analyzed and provided here. The transformation of the regulatory PD and LGD estimates, which are clearly used for risk-weighted asset calculation, into a point-in-time PD and LGD estimates have again to be explained in full detail, and here we need to take into account as well that relevant methodological approach should be acceptable in the eyes of regulators and EBA. And modeling time lag effect in LGD should not be forgotten by all means. For the ECL calculation, the lifetime expected credit loss calculation according to stress scenarios are foreseen. Derivation of stressed lifetime PD profiles from the initially driven approaches needs to be explained. Modeling stressed lifetime LGD vectors having regard to collateral value vectors, haircuts, and unsecured LGDs might be proving a very difficult task for various institutions, given the lack of data for certain type of collaterals and for certain type of exposures. For the data and IT implementation of the impairment framework, IFRS 9 impairment framework, certain aspects are going to be of importance. Data aggregation required for the relevant subsidiaries in a group structure, if the institutions have been operating in such a group structure, is required. And definition of a flexible IT landscape to ensure ECL calculation in the respective scenarios are absolutely essential. And another important aspect, I don't think we can, we should be really emphasizing that to the utmost highest importance level. A vision set for a reasonably fast functioning ECL calculation framework or ECL calculator for short response time is absolutely priority number one, as interaction with the GSTs might require short-term need for recalculations and simulations, and in case institutions are having doubts in that respect, they should bear in mind that ECB will be looking into the impact of IFRS 9 incorporation and the capital effect of the use of IFRS 9 in this context of stress testing exercise. And herewith I would like to conclude my part related to credit risk.
Next in line after the topic of credit risk is market risk. And here, when we look to the methodology, we once again see the impact of IFRS 9, because the market risk framework covers all positions which are subject to fair value accounting according to the IFRS 9 logic. So whenever assets which are accounted for at cost right now have to be accounted for at fair value under IFRS 9, think of certain loans and the SPPI criteria, for example, these are now subjected to the market risk framework. and the same is also true for positions in hedge accounting relationships, which was not the case in the 2016 methodology. As before, we have two approaches: the comprehensive approach, which requires a full revaluation of all fair valued positions on the one hand side, and the so-called trading exemptions for banks without internal market risk models, or for banks which have only a very limited amount of market risk capital requirements, and these banks will be allowed to use a more simplified approach for their trading items. However, they are still required to full revaluation of all fair value positions that are not held with trading intent. So, for example, all the fair value through OCI positions under IFRS 9 will still be subject to the full revaluation, even when we talk about the trading exemption banks. As before, banks have to apply if they want to use the trading exemption, and this has to be approved by the regulator. If we look at the modeling, there is a number of more or less smaller changes to the methodology as compared to 2016, and one of the most important parts of these changes in methodology is the requirement to stress the model uncertainty reserve. So talking about level 2 and level 3 assets where there is no observable fair value. Here additional stress has to be conducted using banks' own models, and this was not the case under the 2016 methodology. Smaller changes concern, for example, the treatment of sovereign positions. There will be no more separately defined haircuts for sovereign positions, but they will be treated as other fair value positions as well. And there have been some changes to the calculation of the floor for the net trading income, which is now calibrated in a less conservative way than in 2016. Looking at the templates and the reporting requirements, there seem to be some simplifications, some changes in segmentation, which will have to be analyzed, especially when looking to the IT solutions that have been established in 2016 and which will surely have to be adopted to deal with the new templates as well. And especially the historical net trading income now needs to be reported on a monthly basis, and information which should probably be available within the banks, but which has not been reported in such a granular way either in 2016 or, for example, in the FINREP templates. Next in line is net interest income, which has been a huge challenge in 2014 and 2016. However, here we see really only very minor changes in the methodology, very minor changes in the information that is to be reported, and also a very small impact, if any, of IFRS 9 as compared to credit risk and market risk. Once again, banks are required to use their own methodology to calculate stressed interest rates, dividing them between the margin and the reference rate. There are some pass-through constraints, how an increase in interest rates on the liability side feeds into the interest rate of the asset side. And one of the more interesting changes is the treatment of non-performing exposures. In previous years, there was a clear statement that no interest income from non-performing exposures could be taken into account in the adverse scenario, and this has been changed to align it more to the accounting treatment of these assets. Also, there have been some modifications to the floors for the deposits, and this is one of the major challenges now, that banks have to be able to produce information which is consistent to the information that they provided, for example, in the ECB's IRRBB stress test that was performed at the beginning of 2017, but also, of course, as before, the information provided on the NII templates needs to be aligned, for example, to the FINREP reporting templates to make sure that it's the same net interest income that is reported in both templates. The rest as I just said, is only very minor changes to the methodology or also to the reporting templates. And this is basically also true for the topic of operational risk. As we have seen in 2016, the methodology for operational risk was to some extent enhanced to cover the so-called conduct risk as well. And as before, the big challenge in 2018 will be to identify those conduct risk and material conduct risk events that took place and then calculate the impact using banks' own methodologies, but also documenting in a very precise manner which conduct risk events have been identified, which events are not treated as conduct risk for the use in the stress testing. So basically only very minor changes in methodology, but still a lot of challenges for the banks to deal with, because the supervisors obviously look very closely at this topic of conduct risk, and banks will need to look into their internal databases, into their op risk loss collection, to be able to identify and document properly which events to look at for the op risk and conduct risk section of the stress test. Now, turning to other items with an impact on the P&L, the biggest change here is that banks are required to use their own methodologies for the non-interest income and expenses. There is no fallback solution by the supervisors, as was the case in 2016. So banks are required really to use their own planning processes, to adapt them to the macroeconomic scenarios provided by the supervisors, and to create the results for those non-interest income and expense items. There are once again some flaws and caps to be taken into account when doing so, and the second most important change as compared to 2016 now is the treatment of the so-called one-off exemptions. As you may remember, there was quite some noise about these one-off exemptions that had been granted to some banks in the 2016 stress test, with a lot of discussion on how this impacted the overall results of the stress test. And therefore, the plans for 2018 are for banks to report upfront which one-off exemptions they want to take account of, with the supervisors either agreeing or not agreeing to for the banks to use these one-off exemptions. This will all be done before the stress test starts in earnest, and once this decision has been made by the supervisors, there will be no further opportunity for the banks to provide one-off exemptions or to use them during the stress test. Now, having covered all of the P&L items, we come back to the topic of risk-weighted assets and their treatment during the stress test.
Thanks, Stefan. So as Stefan mentioned, having heard the detailed, should we say, differences in the 2018 methodology compared to the 2016 methodology, I'll wrap it up and show what some of the differences on RWAs and capital definitions. First of all, within credit risk RWAs, we already heard from Kaan. I guess the big change or the big impact on banks for the 2018 stress testing process is impairments needing to be calculated according to IFRS 9 and stressed according to IFRS 9. And I guess we're all hearing in the market that will be a key challenge for banks through the 2018 process. Other provisions analogous to the EBA stress test in 2016, analogous, just a fancy word of saying, remains the same. Credit risk securitization RWA, firstly, capital deduction items not to be calculated with a 1250% risk weight and instead directly deducted from capital, with other provisions being the same as the 2016 EBA exercise. An open point here with regards to the expected new securitization framework. Of course, if this falls between now and the end of 2017, or by the time the banks will run their stress testing processes, then the new provisions will need to be taken into account in the 2018 stress testing process. Market risk and operational risk, RWAs, no changes from the methodology for the 2016 exercise, so not much to report there. Finally, with regards to own funds, two new things, well, to some extent linked. First, the opening balance as of 1st of January 2018 will need to include IFRS 9 effects and respective transitional provisions. And there should be a detailed statement of these IFRS 9 transitional provisions with regards to own funds. So having said all of that, and getting a bit of an idea on the 2018 methodology, and especially how it compares to the 2016 methodology, we now look at some of the lessons learned from the 2016 stress testing process, and also look at some next steps that banks should be starting to think about. So starting with some of the lessons learned, I think the overall summary from this is that banks should be thinking, if they're not already, now about starting to plan for and putting in place their programs for the 2018 stress testing process. So we go through this one by one. Firstly, a clear definition of roles and responsibilities, communication structure and decisions, and escalation processes should be in place. I think this is definitely key, and especially for those banks which are multi-jurisdictional. This is particularly important because everyone needs to be on board, have clearly assigned roles and responsibilities, and be working towards the same goal. And of course, the other thing here is these processes are obviously multifunctional, covering at least across risk, finance, and IT. So ensuring that right up front there's a clear definition of what people need to do by when, and that these milestones are being tracked is clearly something that needs to be in place. Number two, of course, supervisors expect short-term reactions to any requests, and so resources need to be available within the required period of time. This again is on the same point. The planning should be done, if not started already, should be starting now, such that the right level of resources, but also proper resource planning can be put in place to ensure that the stress testing process or the exercise is as smooth as possible. Assessment of the current data and IT infrastructure and involvement of IT department. I mentioned before that these processes in 2016, as it will be in 2018, is multifunctional and includes significant input from IT. There is a huge amount of data that's required to be presented in the templates, but also to support the stress testing processes as well. So it's important to get data and IT functions on board and in line as quickly and as early as possible. Number four, if results are calculated on a decentralized basis, it's important to ensure consistent methodology for the accurate aggregation of results. Some banks that I'm seeing now who are already starting to think about standing up their programs for the 2018 process are even setting up separate work streams, which will be for aggregation, because of course this is a difficult thing, especially for those banks which have a more decentralized or a multi-jurisdictional model. So where, for example, models may sit outside of Europe, ensuring that when the results are aggregated, they are aggregated in a consistent way. Number five, templates should be filled and aligned to results of CoRep and FinRep. And again, of course, it's the challenge in terms of quality assurance overall, but reconciling to CoRep, FinRep reports, we're seeing in the market that some banks are setting up specific work streams dedicated to quality assurance and to these reconciliation processes. And ensuring that it's as efficient as possible and trying to reduce the amount of resubmissions that would be required through 2018. And finally, detailed documentation of modeling methodologies and key assumptions facilitates communication with supervisors and can prevent top-down adjustments from them. I think that's key, and that's a very good point. But what it can also do is assist with future stress testing processes as well. I think what's clear is that the EBA stress testing process is not going away. At least on a biannual basis it will be done, and possibly more often from the ECB for those directly supervised banks. And so having a clear documentation of all assumptions and methodologies that are being used from year to year can help by making that process as efficient and as pain-free as possible. So given all of that, in terms of next steps and where banks can go from here and potentially how PwC can support you within this, we separated this into 4 key areas. The first one around know-how or content knowledge about stress testing, about the EBA stress testing methodology, and about some of the key methodological aspects to that, IFRS 9, for example, and other stress testing modeling methodologies. That's clearly an area where we can support. In terms of providing tools, so tailor-made automated solutions, whether that be for the aggregation of stress testing results or whether that be for stress testing specific risk types. We mentioned before, and we've been hearing from Kaan earlier on, that IFRS 9 stress testing will be a key challenge for banks. Well, it's a key challenge anyway, but stress testing on IFRS 9 balances on an IFRS 9 basis is a key challenge for banks. And so, you know, being able to have access to tools and methodologies that can support with this is something that can be extremely helpful for banks. On the left-hand side, data, so providing resources, but also providing know-how in terms of data collection, data analysis, data reconciliation, to ensure that the data that is used is correct, complete, and accurate. And ensuring that the overall data quality is managed. And finally, assisting with the Q&A, assisting with a dialogue with the ECB, ensuring that there's a structured approach to handling requests, and also ensuring quality assurance and timely delivery to the ECB is clearly where we can help in this area as well.
Yeah, thank you very much for this presentation. Thank you, Kaan. Thank you, Ryan. Thank you, Stefan. I think that was really, really a good presentation, very detailed, and definitely shows how big the challenges of the EBA stress test 2018 are going to be. I would like to thank you all for your attention. This is unluckily already the end of this episode of the Basel IV Channel. I hope you join us again in the next episode, and I hope to see you soon again. Thank you very much.